From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for January 16th, 2026. If you're feeling like you need to get out of the house and into the cold, it's the annual Samson Stomp at the Zoo this Sunday, but dress warm. Our Milwaukee Bucks are home Wednesday with the Oklahoma City Thunder, and the Packers are home this weekend. No, literally, they're in their houses this weekend.
Joel, you got that one quicker than we did.
Okay, here we go. In Phoenix, a Waymo passenger got out of the self-driving car after it stopped dead on the railroad tracks, with a train bearing right down on it. The passenger, who is a professor at Arizona State University, said about the close call, "I kind of feel sorry for the car. It obviously made a bad decision." Life as a whole has changed dramatically in the last 20 years. For example, this past Monday night, they held the Golden Globe Awards, and one of the big stories was the actor Sean Penn was smoking indoors and in public, and not even pot, just regular cigarettes. Shocking. And finally, TikToker is getting millions of followers for riding his horse through various Target stores in New York City. He amassed 10 million followers, and then I mentioned the horse leaves behind an organic memory in every store. So far, he's avoided arrest, and so has the horse. On the podcast today, we have Adam Baley, Kendall Bauer, Joel Dresang, and with a wrap-up of the week, here's Kyle Tetting.
Well, thanks, Max. An up and down week overall for the markets, but finished down overall. The NASDAQ down 0.7%, closing at 23,515. The S&P down 0.4% on the week, closing at 6940. And the Dow Jones Industrial Average down 145 points on the week, down 0.3% to close at 49,359 for the year. NASDAQ up 1.2, the S&P up 1.4, and the Dow up 2.7. You know, Adam, we say it's all about earnings and interest rates. Felt like we were adrift a bit over the course of the end of the year last year, which nice little march higher, and then kind of to start the year. And now as we begin earnings season in earnest, forgive me if that's too much alliteration, but as we begin earnings season in earnest, not a ton of new news just yet, but hopefully the markets have started to transition towards what comes next. Overall earnings forecasts are pretty strong. What are you seeing right now?
Well, we're right in the middle of earnings season. We still got a few more weeks to go where corporations report their fourth quarter earnings. How did they do finishing up the year? And then give us some more guidance. I think more importantly, give us the guidance on what do they expect in 2026 and beyond. And as we're looking at earnings coming in for 2025, somewhere around 12% earnings growth year over year. That's solid. It is down from what we thought it was going to be when we started 2025, but still 12% is a solid number for earnings growth. And businesses are giving their own estimations now of what to expect going forward for 2026. Earnings growth, at least initial estimates, somewhere around 15% earnings growth. Candidly, that feels a little bit rosy at this point. Just for our own listeners' edification, usually when we start the year, earnings numbers come out pretty lofty and then get walked back gradually throughout the year. That's just kind of the normal course of it. But you put all this together, earnings still pretty good. Stock prices are still really high relative to earnings. The forward-looking PE on the market is somewhere around 22 to 23 times future earnings. That's expensive by virtually every measure. But historically, investors have been willing to pay somewhere 16 or 17. So earnings are really going to have to come in line with expectations. A lot of this has been priced for perfection.
And I think what's interesting there is that we have gotten strong earnings growth, and yet those multiples have continued to expand because the stock market's outpaced that earnings growth. And so you can do that for a little while, right? You can see stocks growing faster than earnings if the expectation is that earnings are going to keep up. Eventually, you either see things start to slow down a little bit in the stock market, and maybe that's where we're headed, is that stocks will come back to reality a little bit as earnings now have some time to catch up. Or the worst part is maybe stocks do a little more than just coming back to reality. Earnings maybe don't hit those targets that we're thinking about, and now you've got a backstep that I think is a little more concerning for investors. The problem, of course, is that the longer we go assuming that's what's coming, and the more investors bet on the fact that, well, yeah, eventually we're going to have to catch back up, the less likely it is we see that near term, because all the sellers that are going to sell have already done that. And so when we talk about things like markets climbing a wall of worry, well, one of the reasons they can do that is that if everybody's afraid, well, they've probably already sold what they're going to sell. And so I think fair to point out those stretched valuations, fair to point out that that's been the case for a while, and relative to history, that can be a bit concerning. Also fair to point out that the end isn't near simply because stocks look a little bit stretched, or, again, to be fair, maybe a little bit more than stretched. That's been the case for a while, and it could be the case for a while longer. You know, Kendall, one of the things that really stood out this week, last week, really over the span of the last few, is just how much headlines, and in particular headlines on some very particular topics, have driven the stock market this week. We got word potentially that the government was looking to cap interest rates on credit cards. All of a sudden, banks, which were in the midst of their earnings reports, took this big step back. What are you seeing as you kind of look at markets, and how willing I think investors are to respond to what's been kind of sometimes maybe an announcement without any really policy backing it?
Yeah, well, I think we're living in that day and age these days. It was interesting to follow some of the reactions this week on the credit card capping piece. I think people like this idea of trying to limit, potential predatory moves by big credit card companies. But you got to remember, too, that could also have an impact on earnings, and that could also impact the market. So there's two sides to that equation. And I'm not sure that we'll see anything done with it. I mean, there was just talks today of a Trump card, maybe in lieu of capping broader interest rates. So it seems like things change day to day. But, there's always something interesting going on.
And I have to assume that Trump card would be a gold card, correct? That's in line with our typical expectations of the president. But I think the challenge is that we are still living in a point in time in which we get a lot more announcements than we do practical policy. And investors are fickle, and they can, I think, respond at times to expectations of what those announcements might lead to without any clear expectation of what's actually coming. And so some of what we've seen is simply trial balloons, right? Hey, I'm going to throw this out there and see how it's received by the market, see how it's received by the parties that might be impacted by this, in the hopes that maybe we can find something that might be workable policy. And I think sometimes it's just bluster, right? Sometimes it's, hey, this is maybe an opportunity to just get some feedback.
What I read was that the credit card cap announced this week would have gone into effect January 20th. That's next week. I just don't even understand how that could even be possible.
Or write the legislation for that to be in for next week, right?
Or even write the order, yeah.
And of course, the challenge becomes, if you are a credit card business, if you're a bank that's into consumer lending or revolving debt, you are going to be far, far less likely to extend credit to even remotely questionable customers, because if you are capped at what you can charge those customers, you're not positive you can recoup your losses if they don't pay you back. And so the knock-on effects of those kinds of policies aren't simply that costs go down for the underlying borrowers. It could simply be now that borrowers are locked out of the types of financing that have historically been the place they use in cases of emergency. And so I think it is a much more far-reaching impact than just, costs are a little bit lower for borrowers.
Yeah, talk about the unintended consequences. And, I can appreciate, having less interest for credit card debt for people. That can be a good thing. But price fixing, which is what this is akin to, setting the price for, here's what credit cards is. It's like, setting the price for beef or for gasoline or something like that. And we have a laundry list of history at our disposal on how price fixing has gone when government says, here's what the price is going to be. Last time we approached that was back in the Nixon era in the 70s, where we fixed prices for oil and beef. And the long-term consequences were it created a lot of turbulence, a lot of unintended consequences, and we had to part ways with it in short supply. But that's essentially what we're doing here. We're trying to fix the prices on credit cards.
And I think we're so used to operating in this free market economy or some version of a free market economy that is focused on cutting through whatever restrictions, whatever red tape might be out there. Yeah, we have some consumer protections, we have some borrower protections in place, but if the goal is to have more freedom for businesses to operate, not more red tape for them to fight through, well, this very much, at least in terms of capping the borrowing rates, seems like, here's some more tape you're going to have to deal with in order to get to your ultimate goal. You know, the constant thing we come back to with so many of our clients, Kendall, is what's supposed to happen when you're not here anymore? How do you talk to your family about what happens with your assets, and not just your investment assets, but even more importantly, a lot of the personal property, a lot of the the tangible things. And there was an article in the Wall Street Journal talking about how much transition is coming to the housing market. I know you were telling me as I was pointing out that article that you had a conversation with a client just today. How do you navigate some of that conversation, and what are the things you really want to highlight?
Yeah, I think important to have your ducks in a row. We were talking about that article in the Wall Street Journal, some pretty insane numbers coming down the pipeline with some of the wealth transfer over the next few decades from baby boomers to Gen X to millennials, and specifically in the housing market. Somewhere to the tune of $4.63 trillion is the estimate over the next 10 years that Gen Xers and millennials are set to inherit in global real estate. So we're not talking about assets, in markets and retirement accounts, strictly just in housing. So that sparked an interesting conversation about, having those conversations with your family while you're here. If you own properties or things of sentimental value to maybe your family specifically, or to individuals within the family, sitting down and discussing those things, having a plan in place so that when that day comes and you're no longer here, it's a lot less stressful on your family. So properties are a great example. If somebody has a cabin, a lake house, we have a lot of snowbirds that are clients. You may have one member of the family that loves the family cabin up north, and another one that's more akin to sitting on the beach down in Florida during the winter. So how do you position those things to transfer as smoothly as they can in those circumstances? Well, you have to have a plan in place that starts with a general estate plan, working with an estate planning attorney, having a will, finding out whether or not a trust makes sense. That's going to be specific to each and every individual. Not everybody needs a trust. Some people should probably have a trust if their estate plan's a little more complex. So I think the bigger takeaway for me is start that conversation while you're here. Bring your kids in to meetings with their advisor here. We love to do that. We will carve out extra time. But I think, again, waiting to have that conversation or avoiding having that conversation leads to more difficult conversations and circumstances down the road.
And Kendall, one of the things that tends to come up in my conversations with clients, especially as it relates to that vacation home or that cabin or that hunting lodge, is, are the kids going to be able to afford it? Are they going to be able to afford the upkeep, the property taxes, whatever else might come with that place? And I think part of that now is ensuring that not just the personal property, the tangible property, the real estate, but that the investable assets are titled in a way that allows the next generation or the inheritors of those ultimate assets to be able to accommodate whatever that variable is, right? If it's that, well, we want to title the house to the trust because we created this wonderful estate vehicle and the trust is the answer. And again, you so rightfully point out, it's not the answer for everyone, but there are plenty of people it is. Well, now do we also have other assets in the trust that can support the house? And so that's where conversations are so important early on of here's not just what we did, but here's our thinking behind it, right? Sitting down with the kids, with the grandkids and saying, here's how we're helping you protect yourselves, but also how we're making the conversation easier between your siblings, between your relatives, so that there isn't the argument about what should we do here. We're telling you what to do. We're telling you how we're going to make it easy.
Do these conversations ever result in the children saying, well, actually, here's a better way to do it, and there's more of a give and take that way?
What I have seen, Joel, in these conversations is sometimes kids that go, I know you think I want that home, I want that vacation home, but honestly, we'd rather travel the world. And when you're not here anymore, no offense, Mom and Dad, but maybe we'd enjoy it for a summer or two, and maybe you think that's what we want, but we're thinking something else. And I think that's the hard part of the conversation, is not just saying, well, this is what we say is going to happen. Well, yeah, you earned the right to be able to do that, but also recognizing that it's going to be out of your control at some point in time, and giving your ultimate beneficiaries the opportunity to say, well, that's not actually what I thought we were going to be doing, so that you can come to an agreement now on, well, here's the expectation, right? That, no, I want you to be able to take the grandkids there for a few years, or no, I want it to be out of the family right away, because I have had those scenarios where then maybe Mom and Dad said, well, we were really only holding on to it because we thought you wanted it. And it's really been a burden on us for the last 5 years, and so maybe there's somewhere else this should go. And it's amazing how once that dialogue starts to open up, that's the role we often play, less as financial advisor and more as maybe the counselor, sometimes the marriage counselor of, well, no, let's open up the dialogue so that we can get to what's really the best purpose for this. And again, I think those are the right conversations to be having early on, so that the entire plan is built around what do we actually want to happen, and not what did we think was supposed to happen. Joel, a busy week overall for economic data. The one I think a lot of us were holding our breath for early in the week, the Consumer Price Index. Okay, more of the same, running hotter than we hoped, but seems to have mellowed a bit, at least over recent months.
We had the numbers for December of the Consumer Price Index, which is the broadest measure of inflation that we use. And it was the same annual rate that we saw in November, 2.7%, way down from 9.1% where it was in mid-2022, but still way above where the Fed intends it to be long-term, and that's 2%. It hasn't really been below 2% outside of the squiggly period when we had the COVID pandemic. We really haven't been below 2% since 2019. So, that's still an issue. That's a problem that still needs to be solved, especially grocery prices. I mean, the report actually was pretty sanguine, except for the grocery prices, because that showed a lot of food items that people could relate to up. Beef on a year-to-year basis. Beef was up 16%. Coffee was up 20%. Lettuce 7%. Eggs were down 35%. You take the overall look, and grocery prices were up, so that's caused for more anxiety that a lot of consumers have.
It's a reminder that inflation is still percolating, whether it's consumer prices. We also got PPI, which is still coming in pretty hot. But you look at the components of inflation, what has been driving the resurgence of inflation the past year or so, and it has been core goods, and it has been energy. You look back and say 23 and 24, those were net detractors. They actually reduced inflation because prices were declining there, and now they have reaccelerated. And those are some of the drivers this time around, as you mentioned, like coffee, eggs, or beef and stuff like that.
Electricity costs were up 6.7% from a year ago. I saw in the Washington Post they figured out that average electricity prices nationwide are up 40% since 2020. And those are the sorts of things, like I said, that affect consumer thinking about how fast prices are going up, and that gives them pause to spend, which we keep repeating is what drives our economy. At the same time, we had the retail report, which shows that consumers are still spending. So it's that disconnect we talk about between people worrying about inflation and not being fearful of spending money, and they keep spending money.
Well, I gotta spend because my coffee's now 20% more, and I still gotta get that coffee.
Yeah, I think the constant struggle the last couple of years has been in looking at consumer confidence, consumer sentiment, and looking at the inflation data, and then in trying to kind of reconcile that with what we've seen from retail sales and what we've seen really from the economy more broadly, which is things on the sales side, things on the consumption side, things on the economic big picture side seem to be pretty strong. And it really is only in slicing and dicing and getting a little bit deeper into the data that you start to understand, well, yeah, but not everywhere. And certainly there are some things that we could point to say, well, okay, yeah, but here's some reasons why consumers maybe aren't saying they feel as happy as their credit cards are showing. And I think those are the kinds of things that long-term we're a little more cognizant of, because it can be the sign that, yeah, things might be okay right now, but are they going to transition to weakness at some point in time down the road?
Yeah, for me, the big takeaway from the inflation numbers this week is it might give pause to consumers, but I think it gives pause most to the Federal Reserve on lowering interest rates because inflation is still running hot. And I don't know if we're going to get as many rate decreases as Wall Street might hope. Certainly, you look at the inflation numbers, it would not justify much rate decreases because it's still percolating.
I think if we had a truly independent Federal Reserve, that certainly is the case. I think we are in a world, though, in which we are seeing much more influence placed upon the Fed. And I worry, Adam, that as a result, while the data might say, yeah, don't cut, you may have a Fed that's more open to those cuts simply because that's where the pressure is coming from. I got to be clear as a free market proponent, as someone that believes the Fed plays a sometimes misunderstood role, but an important role in stabilizing the overall economic system, that I want a Federal Reserve that is free to do those things which are necessary to stabilize the economic system, to do the two things they are really intended to do, which is to focus on price stability, that's inflation, which we haven't seen, and to focus on full employment, which for the most part we have. And again, until I think we see some meaningful transition in full employment, we should, to your point, be spending far more energy on the price stability part of the conversation, because that's the Fed's objective. Joel, we got a little bit of data on the housing market this week. We were talking a little bit earlier about some of the generational wealth transfer from housing, but not seeing any of that just yet, and not seeing a ton of movement there.
And yeah, and that's one of the things that's clouding up the whole the housing market. We don't have enough houses available for sale, and so people who are trying to buy a house have to spend a lot more, and so there's an affordability issue, and we aren't moving houses as much anymore. We got numbers from the National Association of Realtors that showed 4.1 million houses sold in 2025. It was even with what it was in 2024 and the lowest since 1995. So you have to go all the way back 30 years to see that low a number of housing sales, and that hasn't been moving much.
And I don't anticipate that it changes overnight. You know, we keep saying that lower interest rates would certainly help that conversation to free up some inventory. We got a ways to go in order to really see the movement we need. And then you add in construction, right? The new homes piece of the conversation just really hasn't kept up the way that we would otherwise need it to. And we got the new home sales number this week that wasn't terribly different than what we've been talking about all along.
Right. And there we saw the median housing price went down 8% from a year ago, but that was because they were selling more cheap houses. Cheap houses, houses below $400,000. So the average went down from the year before that. But yeah, we're seeing with the new home sales, we had numbers last week on housing starts and building permits, and we're just not keeping up with the downfall that we had in housing construction after the Great Recession.
Well, I think additional signs, as we've been saying, it feels like for a very long time on the podcast, that we're getting mixed messages from the economy, that the stock market has largely continued to do well, that fixed income benefiting from a little bit of lower interest rate. I think all of it speaks to the role that balance plays for investors. I think it's a good confirmation that kind of the way we historically have viewed portfolio construction is certainly
Thank you for listening to
it
Money
continues
Talk
to
with
be
Bob
the right way to
Landis.
get the best
If you
possible
have a
return
financial
for a
question you
certain
want
level of
answered
risk.
on
And
next
so
week's show,
I'm encouraged that
email it
amidst
to
all the
moneytalk
noise, all
at
the confusion,
landis.com.
we're still headed down the right path. With that,
To
we
keep
enjoy doing the
informed
program for you. We'll
throughout
talk
the
to you again
week,
next week.
Visit our Money Talk page at landis.com.